Hello and greetings to all. Today we shall be discussing about IFRS 15, that is revenue from contracts with customers. Now this standard is considered to be a little technical, and my effort here is to give a simplified version and overview of this standard to make you understand it in a nutshell manner. Now this standard talks about a 5-step model for revenue recognition. Step 1, we need to identify the contracts with the customers. Step 2, then we need to identify separate performance obligations. Third step, determine the transaction price. Fourth step, allocate the transaction price. And last but not the least, step number 5 is recognize the revenue as and when an entity is able to satisfy the performance obligations. Now let's try to understand these steps individually. Now step 1 states that we need to identify the contract with the customer. This contract may be either written or oral or implied. But however, there are certain identification rules. And these rules are: number 1, the parties must have approved the contract. Number 2, the entity is able to identify each party's rights, that what are the various goods and the cash that is involved in the whole contract. And number 3, the payment terms can be identified very clearly and specifically. So these 3 rules are fulfilled, that becomes a valid contract with the customer. Step 2, identify the separate performance obligation in the contract. Now what is meant by performance obligation? Performance obligation is a promise in a contract with a customer to transfer either a good or service or a series of distinct goods and services which are pretty similar to each other. Performance obligations are generally specified in the contract, but they might also include certain promises which are implied by an entity's customary business practices. Now what does that mean? That means that maybe an organization has always provided maintenance free of cost to the customers. Now this creates a valid expectations in the mind of the customer, even though it is not explicitly mentioned in the contract. And number 2, certain published policies or specific statements that have created a valid customer expectation that goods and services would be transferred under the contract, and these are the explicit promises which are attached with certain performance obligations. Now for the purpose of identifying separate performance obligations, we need to actually determine the goods and services which can be accounted for as performance obligation, but subject to the fact that the following 2 conditions are fulfilled and satisfied. And what are these conditions? Number 1, the customer can benefit from goods and services either on its own or in combination with the other resources. And number 2, the entity's promise to transfer goods and services to the customer is separable from the other promises which are there in the contract. Coming to step 3, we need to now determine the transaction price. We need to consider the terms of the contracts and its customary practices in determining the transaction price. Let's consider the following factors while determining the transaction price. The first is the variable consideration. Now here, the transaction price is actually adjusted for performance, for discounts, for incentives, for penalties, etc. Then comes the time value of money. Now transaction price in this case is adjusted for the effects of the time value of money if the contract includes a significant financing component. Point number 3, in case of any kind of a non-cash consideration, we need to measure it at fair value, which can be shares, which can be materials, which can be labor, etc. And number 4, any consideration payable to the customer is treated as a reduction of the transaction price, maybe in the form of coupons or any kind of vouchers or volume rebates, etc. Now, after determining the transaction price, the next step, that is step 4, is to allocate the transaction price to the performance obligations. Now, if there are multiple performance obligations in a single contract, the transaction price should be allocated to each performance obligation on the basis of its relative standalone selling prices. These standalone selling prices should be determined at the point of the contract inception and represent the price at which an entity would sell it as a promised goods and services separately to the other customers, which means that we need to consider it at a price which an entity is going to sell normally to other customers and the buyers of that particular good or services. Now, there are three basic ways to estimate the standalone selling prices. Number one, the market assessment approach, which means directly observable method, which is to be accounted for from the market. Number two, the second method, that is the expected cost plus margin approach. Now here, what we do is we forecast an expected cost of satisfying the performance obligation, and then to this we add a certain adjusted approximate profit margin to it. The third is the residual approach. Now this is wherein the total transaction price is deducted with the amount of the sum total of the observable standalone selling prices. Now this is one method which is not generally used and is to be used only when either the selling prices are highly variable or they are highly uncertain. Otherwise, in normal cases, we generally avoid to use the last method, that is the residual approach. And the last method is step 5. That is, recognize the revenue as and when an entity satisfies its performance obligation. Now, performance obligation is satisfied when the control of the goods and services is transferred to the customer, and the control can be transferred either over time, that is in case of services or service type warranties, or at a point in time when we actually transfer the component part or the total goods and the control of the goods is shifted on to the buyer. Now, in case the performance obligation is satisfied point in time, then the revenue is recognized when the entity has transferred its title or has transferred the possession of the goods, or the customer has accepted the asset and has now this significant risk and rewards of ownership of the asset. But on the other hand, in case the performance obligation is satisfied over a period of time, then there are two methods to recognize the revenue. One, the output method, and the other, the input method. Now, output are basically the goods and services that are actually transferred to the customer. So, the output method records the revenue by measuring the value the goods and services have been transferred to the customer. In case of the other method, that is the input method, the focus is on calculating the cost as a percentage of the total cost to be incurred, or the labor hours used as a percentage of the total labor hours that are supposed to be utilized or consumed while fulfilling the performance obligation. Now, this is the total gist of IFRS 15, although it has been and it is a very complicated and a little technical standard, but I have tried to give you a gist of all these 5 steps which are the core component of this standard. Who am I? I'm Dr. Jasmine Kaur, founder of Tishadz.com, where we have tried to simplify all the concepts related to IFRS and other ACCA courses of all the 3 levels in the best possible manner to you. Wait for the next video. Till then, stay blessed, keep smiling.